Hey, what's up, everybody? Welcome back to Investing Sucks. So, a recent paper that was published by the OECD outlined economic growth projections for the advanced economies of the world. And a rather striking finding from that report was that Canada was actually predicted to be the worst performing advanced economy for not just the next decade, but the many decades following that. As we can see on screen here, 2020 to 2030, they're projecting 0.8% growth in real GDP per capita. And if we scroll down here, they also provide a similar estimate for the future decade, so 2030 to 2060, and they're saying it'll be about the same, 0.8%. Now, some of you may be wondering, what is the actual significance of this number? It may just sound like an economic metric that maybe doesn't really mean a whole lot to you. And I wanted to break it down in such a way that anyone, regardless of whether you have an understanding of economics, can actually fully understand it to know what this actually means and why it actually might be important for you if you are a citizen of Canada or if you're just concerned with the global economy as a whole. So I wanted to break it down here. So I've broken down the entire, I guess, phrase of it. So again, this is just to make sure that everyone's kind of on the same page. I'm sure some people watching already understand what this means. But the word real, so the first part of that means inflation adjusted. So the reason this is important is because GDP growth coming from just higher commodity prices, higher cyclical commodity prices, is not really considered sustainable. And Canada has historically seen their GDP fluctuate depending on price of oil because it is such a significant part of our economy. It's our largest export. So things like that aren't really considered to offer, real GDP growth because it's not growth in actual stuff that is produced by Canada, which is more indicative of living standards increasing. If a commodity price just goes up, then that probably is temporary and it's not really going to last a whole long. So, and then GDP per capita. So you probably know what this means, GDP, gross domestic product. So the total value of stuff produced by a country, and per capita means on a per person basis. So the way you can ensure that an economy is going to make its citizens more wealthy, have higher living standards and just better off in general, is if GDP per capita increases. I mean, if you look at GDP per capita for all the countries of the world, you're going to see a pretty strong correlation with the lifestyles of the people who live in countries with higher GDP per capitas versus those of lower GDP per capitas. And then the last word is growth, which is just referring to the compounded change, you typically on a year over year basis. So all that summed together, they're saying is going to be 0.8%, which as we saw previously, is not really considered to be that good. If we go back to this chart here, it's the lowest of all the advanced economies they have here. And Turkey is actually number one with about just over 3% projected for this current decade. So why is Canada's economic growth predicted to be so low? Well, there's two main reasons for this, as we can see on screen here. They broke down the estimation of future GDP per capita growth into two main parts. So you have labor productivity in blue here, and in the orange is labor utilization. So poor labor productivity gains is probably most to blame here. It's not the lowest as you can see, but it is pretty low compared to all the other countries here. And then the orange would be labor utilization. So labor utilization is just the total hours worked by the country as a whole. So this can go up or down depending on many things. And one of the reasons why it's projected to go down is because of age demographics in Canada. And specifically, one thing the OECD report mentioned was that Canada has a retirement age that is usually a bit below what the statutory retirement age is. So in Canada, this is what this chart shows here. You can see all these dots on screen, which are the various countries represent the statutory retirement age, which in Canada is 65. This is Canada here. And then in blue would be the effective retirement age. So I guess the average retirement age for men, and then in orange, it's for women. So for Canada, for men, it's about 63 and a half years, and then for women, it's about 62 and a half years, which is both below the 65 here, which is kind of in the middle of the pack compared to all the other countries. You can see there's a few that are a lot higher, a few that are much lower. So no real striking data here. But what does kind of stand out is when you look at Canada's age demographics. So this here represents the percentage of Canada's population in various age demographics, so 0 to 14, 15 to 64, and then 65 plus, which would be, I guess, people who are retired in Canada. As we saw from the data we just looked at, people of this age are most of the time they're going to be retired. And this percentage has been increasing quite a lot in the recent years. We can see 2011, it was about 14.5%. and then 18.5% in 2021. So if more people are reaching retirement age, then there's going to be less labor hours, which I think is the rationale behind what we're seeing here. Is Canada's going to have an aging population, so there's going to be more people retiring, less people working, so there's going to be lower labor utilization. And then labor productivity is also another part of that. In fact, it's probably the main reason why Canada is predicted to be so low. Now, labor productivity is going to result from things like technological innovation because it's what increases the output per worker. It's the average person, are they able to produce more stuff, produce more value into the economy, which is what's going to lead to higher living standards for that country. So next, I want to dig into a few of the reasons why the report said this is projected to be so low for Canada specifically, and then look into it to see, is this actually a uniquely Canadian issue? What is it about Canada that makes it the way, this report is saying they are? Now, one data point we could look at to help understand Canada's GDP a bit better is look at how it's broken down by the various industries. So that's what this is here. It's showing as of June 2021, Canada's GDP broken down by the top sectors that contribute to it. And right at the top here, we can see we have real estate rental and leasing. So this sector is going to be anything to do with managing, selling, or renting or buying of real estate. So things like home inspection, appraisals, commissions, a whole laundry list of services tied to housing, and also rent and leasing that gets paid. And to clarify, the sale of a house that was already built and had a previous owner does not contribute to this. So the issue with having housing as your biggest sector is that it's not exactly one that's going to grow based on innovation or technological advancement, but it will grow based on things like easy monetary policy, like low interest rates that just encourage more activity in the housing market because it's easier to get mortgages, it's easier to get financing. And because of that, you're going to see more economic activity happening when there's easy monetary policy, essentially, which at present time monetary policy has been easy for quite a while. And personally, I think it's been exhausted, and we're already kind of seeing evidence of that. And of course, now with inflation going high, the only tool that central banks have to control inflation is raising interest rates, which will lower housing prices because it increases the cost of financing a house purchase, which means this whole sector is significantly at risk. So to illustrate where we're at currently, this is just a quick overview of where the policy benchmark rate for the Bank of Canada has been. We can see it's gone up pretty fast. And this is all in response to the rising inflation. Now, one interesting statistic I heard recently, which may have just been applying to the US, but I'm sure it's a similar case in Canada, is that never in history where inflation has been above 5% has it come down from that without the central bank raising the benchmark interest rate at least to 5%. And we're currently at 2.5%. So if history is any indicator of what the future may hold, it means we could be in store to seeing much more interest rate hikes into the future, into the range of 5%. That's what history would tell us. I'm not making a prediction here and saying that's definitively what would happen, but it is certainly a possibility. And I think to most people that would seem reasonable. It's definitely not something that seems unreasonable. Inflation has started to come down a bit, but it still is historically quite high. Now, the next highest sector is the manufacturing sector, which I was actually pretty surprised to see because Canada isn't really seen as a country that makes things. Although we do have a company called Magna International, which does about $40 billion in revenue annually, which I'm sure is included as part of the manufacturing part here. So that's about a quarter of this number. So I guess it does make sense in some way. But in third place, we have the oil and gas industry, which is one where you can see some growth in this industry based on technological innovation, which would lead to gains in real GDP per capita. An example of this is the rise of fracking technology. Now, I know that fracking is generally seen as a bad thing, but it has actually done a lot to reduce carbon emissions because it helped move a lot of economies off of coal-based economies into natural gas because it was a much more efficient way of extracting natural gas that previously couldn't be extracted. So it actually did do a lot to help the economy and make it better overall. In fourth place, we have finance and insurance. So this I really just like to think of as managing the wealth of Canadians, which there can certainly be some innovation in this sector, but it would take a lot because banking specifically, we all know, is an oligopoly in this country, and the IT systems that the banks use, even to this day, are IT systems that were created in the 1980s. So I don't really want to count this sector out. It doesn't really strike me, though, as one that we're going to see a ton of growth from that would lead to, like I've said many times, better living standards, which result from gains in real GDP per capita. So this is one that it could continue to grow, and in some way it is tied to the housing market because loans that are received or loans that are given for mortgages are included in this sector. So it is similar to, I guess, construction because that's in some way tied to housing, and then obviously the top one here. So throughout this whole section here, a lot of these are in some way dependent on housing. And what I've been trying to do is understand which of these sectors could we see very substantial gains in due to technological innovation. And I think it is possible to see it in some of these, but none of them really strike me as ones that you could see substantial gains from, especially the top one, something like this, for the reasons we discussed. So for some additional context, what I wanted to do next was compare this data here, so the breakdown of GDP per sector for Canada to that of the United States, to see if there's any key differences and to see if that these issues are uniquely Canadian issues. So there's this data here, which shows the exact same data we're seeing here, except in a percentage format. So we can see in total, real estate rental and leasing contributed about 13.5% to GDP in total. And then we could also see the fourth category, finance and insurance, contributed under 7%. So those two combined make up about 20 to 22, 23% of the total GDP. So let's compare that to the US. And we can see that it's actually quite similar. Now, in this data here, it is showing the two combined, finance, insurance, real estate rental, and leasing, and the total is 22.3%. So that's not really that different than what we saw in Canada, which I found interesting because the narrative is that the Canadian economy is extremely dependent on housing. But what it appears from this data, at least, is that we're not that much different from the US. But I think the difference truly lies in the underlying fundamentals of housing in Canada, which are weaker than what's in the US currently. So it's more sensitive to a decrease if the housing market in Canada starts declining, because then you're going to start seeing less activity in that sector overall, less investment, which is all what is contributing to the GDP number we saw here. There needs to be more activity in the housing market for this number to continue to rise into the future and continue to produce gains in real GDP per capita. So the data that I want to point to is this is data that I actually showed in the housing market video that I did a couple months back on this channel. But this is also data from the OECD, and I think it's really good at just showing the change that has taken place. So it goes back to 2005, and it compares the gains in the housing prices for a country to income gains. So the higher you're going to see a country on this chart, the more their housing prices have outpaced their gains in incomes. So Canada is clearly an outlier here. They're the red here. So they're way at the top above all these other countries. And this is as of Q2 2021. And where is the US in this? So we could see the US right here. So they're actually below 100, which means that their gains in average incomes have outpaced the gains in home prices. So to me, that says because Canada housing prices have increased so much, and the fundamentals for housing prices, you could argue, are incomes because people pay for houses based off of their incomes. So if housing prices are outpacing incomes, to me, that signals weaker fundamentals. And so if we see something like rising interest rates, which we have already seen in the increase in the policy rate as we previously discussed, then to me that tells us that this whole sector of the Canadian economy is going to be very sensitive to that. And this could be a drag on the economy overall, which is probably one of the reasons why the OECD is saying Canada's going to have really low real GDP growth because it is so sensitive to increasing interest rates, which would lead to lower activity in the housing market. And then this number here, you could see is at risk to fall or at least not grow as fast as we would need it to. Now, the next thing I want to do is talk about some more uniquely Canadian issues that weren't actually explicitly called out in that OECD report, because the report itself was very technical, and I think there could be more said to the actual causes of the things that were referenced initially, such as the poor growth in labor productivity and then the decrease in labor utilization. So that's what I want to focus on now. And I'm not going to be able to cover every single topic that some people may wish that I cover. So if there is something that you would like to add to this, then please feel free to comment things. I know everyone's going to have their own take on the current state of the economy, and I can't possibly talk about everything, but I can cover a few key topics, which is what I'm going to try and do here. So one of which is brain drain. This is something that I'm sure everyone's heard of. You've probably heard this term before, brain drain. We know what it means, specifically in the technology sector for Canada. And put simply, highly skilled workers highly skilled Canadian workers, specifically in the tech sector, are going to work in the US. They don't want to work in Canada because the salaries in the US are two, three, four times as high. And especially now, with the rise of remote work, you can even earn US wages while living in Canada. And like I said before, the technology sector is one that should generate a lot of economic growth in the coming decades. And if Canadian workers are putting their brains to use for US companies rather than Canadian companies, then Canada isn't really going to see a benefit there. So that's just a brief overview. Of course, you can dig into this issue a lot more, but put simply, if Canadian workers don't want to work in Canada, they want to work in the US because the opportunities are better, then that is going to drag on real GDP growth. Now, the next issue is Canada's declining birth rate. So this feeds more into the labor utilization argument because it speaks into the growth in the population of Canada rather than gains to labor productivity, which is probably the more important thing, but I still do think this issue is really a global issue. It's not something that's specific to Canada, but the reality is that Canada, their birth rate is currently below replacement. So for reference, a birth rate of at least 2.1 is needed for replacement level. And as of 2020, Canada is at 1.4, and it's kind of on a downward trend. So Canada is likely going to face an underpopulation problem, and this is why immigration has been such a key focus for the government in recent years because it's really the only way that they can get the population to grow. I mean, the population has been growing because people have longer lives, they're living longer, which means there's more people alive at a given time. So that can increase the population, but it's not increasing organically by more people being born, which from an economic perspective is quite important, right? And I'm just commenting on this from an economic perspective. I'm not saying whether this is good or bad for society, just from a purely economic perspective. And in fact, the last time Canada's birth rate was even at replacement, which again is 2.1, 2.1 just because 2 represents replacing the parents, and then the point 0.1 accounts for any sort of premature deaths that may happen. So the last time I was at that level was 1971. So it's been a while since Canada has been at replacement birth level, and it's pretty astonishing how fast this drop was here in the decade 1960 to here. I mean, it fell by about 1.5 births per woman is the metric they use here. And if we scroll down, we can see what it's like in some other countries. So we can say we want to look at the United States just to kind of gain perspective. And it's pretty similar to Canada, 1.6. And we can even look at some other countries. Like say we want to look at France. So France here is another developed economy. It only has a birth of 1.8. And then let's look at something like Spain, another European economy, 1.2. So that's even lower. And then we could just kind of look through these and see the countries that have the highest birth rates tend to be poorer countries, right? Not really advanced economies. As we can see here, Somalia, almost 6, which strikes me as extremely high. That's certainly a developing country. 4.1, Sierra Leone, I mean, same story there. Senegal, a lot of African countries we can see here. Pretty much anything that I've seen so far that's in the range of 4, 3 or 4 is an African country. And we'll go through all these, another example here, 6.7. So you kind of understand what the issue is here. I mean, the developed countries, the vast majority of them have their birth rate below replacement, which does signal a future population problem. Now, the next data point that I want to look at is the percentage of a country's GDP that is allocated to spending on research and development. So this is a pretty strong one that is going to indicate future gains in labor productivity. Because again, as I've said many times throughout this video, gains in labor productivity are going to come from things like technological advancement, which isn't going to be specifically things like AI or digitization, stuff like that. It could be technological advancement like fracking, for example. But in order for that type of thing to happen, an early indicator of that is spending on R&D related things because it shows how innovative a country is. So we got all the or a ton of countries here, and I've highlighted a few of them in this graph here. This is also data from the OECD. And we can see here's Canada, kind of in the lower, kind of lower slash middle portion of this. We could see they're down here. And their spending has actually been decreasing, as we can see here. You know, not a sharp decrease, but a gradual decrease going back to 2000, which is not really what you want to see. You want to see this number increasing because it shows that the country is becoming relatively more innovative and they're dedicating more time to, you know, technological advancements, you know, developing new products and services that lead to gains in labor productivity and therefore lead to higher living standards eventually for citizens of that country. And I put some other countries here just as reference. You can see Russia, which is actually quite near the bottom of this. The US is much higher than Canada, and they're one of the top countries overall. China is above Canada as well. And then this gray would be the total for the OECD. And the highest is actually Israel, which is the highest by quite a lot. And then this one here is Korea, which has been increasing very substantially, as we can see in recent years. So I really like this as a way of showing potential future gains in labor productivity because things like patent applications are going to be tied to increased spending in R&D, and those are two really strong indicators of a country's relative inventiveness. Now, personally, what I think this data here for Canada is also indicative of is it speaks to the culture of Canada, which is that we're just not a very risk-taking culture. We're not very entrepreneurial. And that's not to say we don't have great companies and we don't have great entrepreneurs that have come from Canada. But if you just think about it anecdotally, how many people do you know that earn their living from either a business that they created or a product or service that they invented versus just working for an employer? You know, probably not a lot. And how many people do you know that have built a significant amount of wealth through owning property or owning rental properties versus owning their own businesses? Again, it's probably not that much. And the reason I'd say this is because starting a business requires a ton of creativity. It requires a very high degree of risk tolerance. It requires the ability to deal with the unknown. And I just don't think that that is something that's well ingrained in Canadian culture because I don't see that many people going out there and starting their own businesses. And I think, you know, something like this, like the whole R&D spending argument, ties into that as well because when people are being more inventive, they are going to spend more money on research and development. And Canada is trying to do a lot of things to promote this. There's lots of tax credits out there if you're spending on R&D projects. But I think it's really an issue that goes into the culture of Canadians rather than government incentives or anything else. But anyways, guys, that pretty much does it for this video. So again, if you do have something else you'd like to add, please do add in the comments. I know I didn't cover every single economic issue facing Canada inside of this one video, so I am relying on you guys to drop some insightful comments. And I hope you did find value in this video. If you did, then please leave a like and subscribe if you're new to my channel and you like this type of content. And I'll see you guys in the next video.